Well, stocks are up for the third day in a row after a disastrous October. The gyrations are a reminder that investors are grappling with a myriad of issues. Now we're wondering, are higher wages and inflation going to trigger the Fed to overreact? Can this economic juggernaut last into 2019? And will the trade war come to an end or actually escalate? Here now to discuss PwC partner Mitch Rochelle, along with Kingsview Asset Management Chief Investment Officer Scott Martin. Scott, 3 days up in a row. But you can still feel it's palpable, the anxiety in the air. What do you think?
Yeah, it still is, Charles, but that might be a good thing. That might get some buyers back in. It might scare off some of those short holders, too, so that's a good thing and get them to cover. But you're right. I mean, you laid out some good topics there. What's going to happen with this trade war? What's going to happen with the elections in a matter of a week or less? What's going to happen with the jobs number tomorrow? There's still a lot of uncertainty out there, Charles, that I feel need to go right, or at least need to go better than, say, maybe expected to kind of keep this rally going.
So, Mitch, I'm watching yesterday's rally, and we look like we're going to be up 500 points in the Dow. But after that wages and salaries number, 3.1%, the best in a decade, we gave some of that back. We gave half of it back. And then today we came out like a pretty good, almost like a juggernaut. But we saw productivity numbers and unit labor costs was a little bit more than expected. And I'm wondering, how much of a role the Fed seems to be lingering as this dark cloud, perhaps the darkest cloud out there.
There's more suggestion that there's going to be inflation coming in our way. Just look at the forward guidance coming out of companies talking about how they're raising prices, how they're not going to let increased costs due to trade erode margins. So there's more sort of headwind in our face regarding inflation. And the Fed's likely going to see that and keep
raising prices is not something a company can do, right? I mean, companies win a decade. They can say what they want, but if no one wants your product, they're not going to pay more for it.
No question. They got to balance sort of profits and their customer. But the reality is we have a really strong economy. So if there was an opportunity to raise prices, you can do it when your consumer.
Yeah, I guess I'm thinking like in consumer staples, again, yesterday, Clorox. Today is Church and Dwight, the guidance, whatever it is. But it depends on what the product is, I would assume, though.
No question. And listen, and we've talked about this before. There are forces at play that do have checks and balances that keep prices from not going up. But the fact of the matter is there's likelihood that we're going to see inflation.
Scott, whatever happened to the earnings being the thing that ultimately moves markets? Earnings up 26% year over year, shattering expectations, and then stratosphere rarely ever met before.
Yeah, that lasted, I think, for maybe a quarter or so, Charles. And then the market probably took it too well. I think the market probably to that point got a little extended, to be honest with you. Not that it got overvalued, just got a little bit too sanguine. And so now you're seeing, like you mentioned, you talked about some of the staples guidance, Charles. Some of the industrials, too, have talked about some pricing pressure. So you're right. That seems to be taken a little bit harder by the market than it was taken well prior to. And this from being in the market, as does Mitch, that's probably just a reflection of market psychology, which as well as I do will eventually burn off, and the market will take its medication again and realize that even still growing at double digits in earnings is not a bad thing.
Not a bad thing. I'm pretty optimistic myself. Scott, Mitch, thank you both very much. Coming back later.